there, hope all is well. Back at you today with some more RTD news updates. And so from today's title, Auto Subprime Loans and Fraud, you can kind of tell where we're going to be heading today. So I have about 4 or so articles that I want to share with you, all dealing with the current auto loan situation and the crisis behind it. And its similarities to the housing crisis that happened right leading up to the Great Recession. So, and also before we dive into today's articles, I want to give you a heads up. If you did not have a chance to watch RTD Live Talk last night with Gregory Manarino, we covered a lot of these subjects dealing with the subprime housing bubble, auto loan, and student bubbles and things of that nature. So definitely something worth checking out. So let's dive into today's articles. And so I have about 4 articles here that I want to cover, of which one is a more recent article and the other ones are from a few weeks past, but all dealing with the current auto loan crisis that's going on and how it's even trickled over to bonds and things like that. So just to give you an idea what's going on, the very first article here is from wardsauto.com, and it says, rising auto debt foreshadows impending credit crisis. The next one here is from Bloomberg. It says, auto loan fraud soars in a parallel to the housing bubble. The next one here is from Business Insider, and it says, almost anyone can get a car loan now, and that's not a good thing for the country. And then the last one here is from Bloomberg as well, and it says, bonds backed by auto loans look toxic. So let's dive into the very first one. And as always, just to give you an idea of what's going on, I'm going to skim through the surface and leave the article link below for you to dive into it further if you are interested. So let's cover this one briefly. So here we have I'll cover through the top of it a little bit. It says, Euromonitor data shows that U.S. consumer spending on vehicles grew 36% in real terms between 2009 and 2016, while disposable income grew just 15%. It says, in addition, the outstanding balance of consumer auto loans increased 36% in real terms between 2009 and 2016, while the outstanding balance of consumer loans as a whole decreased 7%. Then it gives a little graph right here. U.S. passenger vehicles on the road versus U.S. consumer auto lending. And so here we have auto debt skyrocketing as well as passenger vehicles also increasing as well. Scroll down a little bit more. It says, despite automakers touting better quality vehicles that last longer, the decreasing number of passenger vehicles on the road combined with steady newer car sales suggests automakers and lenders have become increasingly aggressive in driving sales. Morgan Stanley reports that the percentage of subprime auto loan asset-backed securities categorized as deep subprime, the riskiest category, has risen from 5.1% in 2010 to 32.5% as of today. And this is as of May 8th. So subprime, deep subprime, which is the riskiest category of, as they say, asset-backed securities, has increased from 5.1% to 32.5% as of today. So it looks like they're really basically just giving people cars, that can't really afford them. It says auto lenders burned by credit crunch during the recession gradually have relaxed their loan qualification requirements. And as the U.S. economy recovered, Moody's reports auto lenders have allowed recent levels of negative equity for both new and used vehicle purchases, which means outstanding consumer debt from the previous vehicle purchase is snowballing inside of the decreasing or remaining steady at the time of the next purchase. So they're just rolling one car into the next. So whatever's the remaining balance, they may just, roll it right into that new boy as they give you an upgrade. So interesting there, but it's an interesting fact that, they consider, asset-backed securities, which they say is the riskiest category, has increased. So that means people are purchasing those things as investment tools. So some people are being sold, risky. It says the riskiest kind in their retirement portfolios, more than likely. And so they're, that's once again a financial asset that people are considered and actually are being hoarded into. So more information down there below. If you're interested in reading more into it, feel free to do so. The next article is from Bloomberg. It says, auto loan fraud soars in a parallel to the housing bubble. It says up to 1% of car loan applications include deception, firm says. It says trouble comes after rapid growth in U.S. car loans since 2010. And it says borrower fraud in the U.S. auto loans is surging and may approach levels seen in the mortgages during last decade housing bubble, according to a startup firm that helps lenders sniff out bogus borrowers. It says as many as 1% of U.S. car loans applications include some type of material misrepresentation. Executives at data analytics firm Points Predictive Assessment estimated based on reports from the banks, financing companies, and others. It says lenders loses from deception and may double this year. Lenders losses from deception may double this year to $6 billion from 2015, a firm forecast. says those fraud rates are coming closer to the over 1% level of mortgages in 2009. It says when the financial crisis was boiling and more lenders started reporting incidents to one another, Frank McKenna, chief fraud strategist at the firm, said in an interview, said while those losses will still sting lenders, the impact on the overall economy will likely be too much more muted than the housing crisis just because there's less car debt outstanding. Scroll down a little bit more. It says the dealer fraud. It says Point Predictive has put together a consortium of lenders to share data about dealers and loans. It says the growth, now 13 strong, met at the headquarters of Santander Consumer USA in Dallas last month. It says common types of fraud include borrowers lying about their income, and it says and their jobs, including falsifying pay stubs. It says loan applications can also include bogus information about the type of car being financed or its value. It says the deception can be perpetrated by consumers or car dealers or both. So basically, in order to get people to take out these loans, you got people, on the dealer side, just basically allowing people to come in with bogus stuff and not verifying it. And then you have people who know that they can get approved pretty much for anything they want without any real proof of income or, any type of, I don't know, in some cases, not even having driver's license. I know some people that actually has that. And so it's just quite alarming. It says about 3% of dealers can be responsible for all of lenders' fraudulent applications, Point Predictive said in a February report. It says losses from auto loan fraud this year will likely be $4 billion to $6 billion, up from $2 billion to $3 billion in 2015, the firm said. So fraud is increasing as they are trying to get more and more people to drive off their lot with a car. So basically, if you come with nothing, you can leave with something. So quite alarming, but more to read down below if you're interested. Next article is from the Business Insider, and it says almost anyone can get a car loan now, and that's not a good thing for this country. This actually came out last month, but I'll skim through it briefly. It says, in late 2012, Kathleen Boluch needed a new car. A drunk driver had left her totaled, but she knew it wouldn't be easy to get. It says Boluch, if I'm pronouncing that correctly, who lives in Massachusetts, was freelancing and wasn't making much money. She didn't have much in savings. On top of that, she had a credit score below 500, which is considered very risky. It said it took visits to numerous dealerships in the Boston area before she found one that would let her finance a car. And then it quotes her saying, I remember they were on the phone and computers trying to find a bank to approve a loan for me, she told Business Insider. It says the salesman asked Boluch how much she made. I was honest and told him that I am a freelance advertising copywriter and didn't have much. One guy shouted, let's try Santander. They'll do it. To make it easier to get approved, the salesman told her that the dealership could hire her to do some of his advertising and that it would include the income on the loan application. It says, she said, I was naive and got tricked by these jocular car salesman, she said. The dealer was right. Santander Bank approved Boluch for the loan in October 2012. She drove home in a 2010 Chevrolet that cost $18,000, but she soon couldn't keep up with the payments. And then, let me see. And then it would include income on a loan application. The dealership did not keep its promise by giving her a job. So the basically, just more fraudulent activity by dealerships out here. Said they promised to hire her to do some advertising just to get her a car loan and falsify the documents. And then after she drove off the lot, she didn't get a job. So sad story. It says when she read in the story, New York Times, about subprime auto loans and fraud, it says she sent clippings to the Massachusetts Attorney General in late March. To Healy's office announced it would receive a $22 million settlement from Santander Bank over its subprime auto loan securitization. So it just points out a bank here that has been caught red-handed and had to pay out a $22 million settlement. But yet, of course, like always, because they're in the banking sector, no one goes to jail or gets spanked on the wrist. There's just a little small fine. So more article, if you're interested in reading down below, talks about the subprime is booming. And it gives a little chart here. It says year-to-year balance change. And the deep subprime, those risky ones, as you see here, is increasing dramatically. So more information below if you're interested in reading further. And then the very last article here is from Bloomberg, and it says bonds backed by auto loans look toxic. So here we have in the first article talking about the increasing demand or or the risk in having those riskier category bonds. And here we have an article here giving a little bit more detail about that. And it says loans accessible to the least credit worthy represent a third of the market. And so it shows a guy here walking through a car lot looking for, looks like a nice little Cadillac there. It says you might think we were headed straight for Carmageddon. Car sales are at the lowest level in more than 2 years. Subprime delinquencies are near their crisis era highs. Subprime delinquencies. It says deep subprime loans accessible to the least creditworthy borrowers represent a third of the subprime car loan backed securitization market. It says 7-year loan terms are now the norm as borrowers stress themselves precariously thin to make their paychecks match their payment capacity. So 7-year loans now to try to, squeeze somebody into a newer vehicle. And so it says the New York Fed says 6 million debtors have fallen behind, with many more to come. And of course, used car prices are crashing, devastating the collateral lenders can recoup at auction. It says, so why aren't investors in the auto loan backed securitization market a wee bit alarmed? It says, if anything, pricing in this market indicates performance of auto ABS is expected to improve. According to investors in this arena, a year ago, buyers of the riskiest slices of these bonds were demanding yields that were 7.5 percentage points over comparable 4-year maturity swaps. It says a fixed income instrument against which they are priced. As the end of this first quarter, the premium had been cut in half. So here shows a little graph here. Losses on the rise. Said bonds backed by subprime auto loans hit by defaults, worsening recoveries. And so here we have debt tied to prime credit borrowers. So those that are in deep, pretty good standing, pretty good credit is pretty consistent at the very bottom at a very minimum loss. And then you have the riskiest of riskiest, the debt tied to subprime credit borrowers. Then it's fluctuating drastically, but yet it's still on the increase. So definitely not good to be holding on to those things when this thing pops. So just a little bit more. It says auto dealers in the deep subprime space reinforce the pricing environment. Demand for these loans remains robust, and underwriting standards have not tightened in recent months despite the obvious deterioration in the sector. It says, in fact, car loans led the rise in consumer credit in February, excluding mortgages. Household debt now stands at a fresh record of $3.34 trillion. What gives? So its household debt stands at $3.34 trillion. So you got student loans, you got the housing bubble, you got the riskiest of riskiest bonds that they call assets that are just waiting to just collapse. So you got all these things going on here, and this is what's happening in the mainstream news, of which you're not really hearing much about it. And so one of the things that I wanted to just put this out here is because this plays into what me and Gregory Manarino were talking about last night when we were talking about just the bubbles. And he gave a great demonstration of how you have bubbles in the subprime, you have bubbles in the housing, in the every area. He said for the most part has some type of bubble where it's overpriced, bubble in the stock market. And he said that one day there's going to be a bursting or a collapse of these bubbles that have been blown up drastically since the Great Recession. And when it pops or reach the point of zero, it's basically going to be all these asset classes looking for, as you say, price discovery. And so basically everything's going to be brought down to its original free market valuations, which at that point is going to leave a lot of people with some minimized values in their houses, cars worth nothing, and anything else that's been inflated because of this easy credit system that we're currently in now. So just something to consider. And if you found this to be informative, if you know people that are caught up in this, please share this with them so that they can be informed at the fact that they may be a part of this fraud game of giving people easy credit by lying to them, which some things that need to be reported. So hope you enjoyed this. If you are not a subscriber, I encourage you to subscribe to Rethinking the Dollar so that you can be alerted of future interviews as well as news updates to come. So enjoy your day. Thanks.